Members, it is the appointed time and a quorum is present. I call to order the meeting. Today we will use the request to speak system, so please do not switch your seats after you are seated. Thank you for coming on time. The first meeting is the most important because if you haven't listened to the briefing from the administration, you will be at a loss. So first item, election of Deputy Chairman. So this is the Bills Committee on Inland Revenue Amendments, Taxation on Specified Foreign Source Income Bill 2022, election of Deputy Chairman. As notified by the Secretariat, we have only received one valid nomination. That is Mr. Edmund Wong, seconded by Brock Chen and another member. According to ROP, Appendix 4, Paragraph 8D, we can decide whether there is a need to elect a deputy chairman. Is that agreed? If so, I announce Mr. Edmund Wong elected as the deputy chairman of this Bills Committee. Congratulations. Now we will invite the administration to come in to brief us on the bill. Members, do we need to invite public submission concerning the bill? Since the epidemic is still raging on, I propose inviting written submission from the public. Thank you. So if you are ready, Commissioner, please walk us through the bill. Thank you, Chair. The bill stems from a unique background, and it is quite complicated in nature. So I will make use of a PowerPoint to present the bill. Inland Revenue Amendments, Taxation on Specified Foreign Source Income Bill 2022, that is the bill. The policy intent of the bill is to introduce new foreign source income exemption regime so that we can align with the international taxation standard. And also for us to more effectively stem abusive behaviors from double non-taxation, and also to prevent Hong Kong being blacklisted by the EU. Now, the European Union consider that there are harmful elements because there is a lack of requirements for substantial economic presence in Hong Kong for claiming tax exemption of foreign sourced passive income in Hong Kong. There is a possible exploitation by shell companies to achieve double non-taxation. That's why the EU invited Hong Kong to commit to amend our tax laws by the 1st of January 2023, which has to come into effect on the same day. To avoid Hong Kong being blacklisted by the EU, in October 2021, the Hong Kong SAR government made a public pledge that by the end of year 2022, we would amend our tax laws with a view to implementing the new FSIE regime with effect from the 1st of January next year. Whether we can complete the legislative procedures within the timetable is key. If we cannot respond to the EU's concerns, and if we can't show the utmost sincerity to implement the new FSIE regime by the deadline of the 1st of January 2022, it is very likely that we would be blacklisted by the EU. By that time, Hong Kong corporations would be subject to tax-related defensive measures, for example, higher withholding tax rates or denial of deduction of costs or higher tax audit risks. It would jeopardize our reputation as the international financial center. Since the end of 2019, concerning our tax exemption regime for foreign source passive income, the EU has been investigating our regime, and all along the government has been bargaining with the EU for our best interest. As at October, we have had several rounds of discussions with the EU in terms of the building blocks of the legislative amendments. And then we immediately consulted the stakeholders concerning the bill. Between September and November, we have entered into another round of negotiation with the EU. Within the shortest time possible, we are introducing the bill for the electrical scrutiny. And also, we have set out the relevant works on the Council brief. Now, let me introduce the salient points of the bill. Since there is higher incentive for multinational enterprises or M&E to engage in tax avoidance behavior, we will only target M&E group carrying business in Hong Kong in our new FSIE regime. And also, if M&E entity can fulfill certain requirements, for example, economic substance requirements, then the passive income, foreign source passive income received in Hong Kong, including interest, dividends, disposal gains in relation to shares or equity interest or disposal gains, and income from IP or IP income can still be exempted. So the new FSI regime only seeks to target shell companies set up by M&E entities in Hong Kong which do not fulfill the ESR. Individuals will not be affected, as well as local companies and also regulated financial entities, foreign source interest, dividend, and disposal gain derived by them from their business will fall outside the scope of the new regime as well. And also, the general taxpayers who are subject to preferential tax rates will not be affected as well. In a moment, we shall explain the intended amendments concerning carving out the taxpayers with preferential tax rates. Now, we will uphold our territorial source principle of taxation. The new regime will not affect the determination on source of profits. Under the new regime, for taxpayers who have substantial economic activities in Hong Kong, they can still enjoy exemption on the specified foreign income in Hong Kong, derived in Hong Kong. Now, let me use this flowchart to explain the system. And normally, an M&E entity with business in Hong Kong, while receiving specified foreign source income in Hong Kong, we would determine the nature of the foreign source income to see whether they can be exempted. For non-IP income, that is dividends and disposal gains, interest, and so on, as long as there is economic substance by the M&E entity in Hong Kong, that is employing a sufficient number of employees in Hong Kong and incurring sufficient operational costs, these income can still be exempted from tax. For pure equity holding company, the ESR will be even reduced. Now, compared with the existing automatic exemption regime, under the new regime, the taxpayers will have to prove their ESR in Hong Kong. However, as long as they have substantial economic activities in Hong Kong, it shouldn't be difficult to meet the requirements. And also, corporations can also outsource the relevant activities. It is permitted. The outsourced activities have to take place in Hong Kong, and also they have to demonstrate that there is adequate monitoring of the activities. In terms of foreign IP income, taxpayers need to fulfill the nexus approach adopted by the OECD as a minimum standard. The extent of exemption would only apply to income from a qualifying IP asset based on the nexus ratio. To alleviate double taxation risk, there will be a series of enhancements. First of all, besides ESR, we will introduce a participation exemption regime so that taxpayers receiving dividends and disposal gains from overseas can apply for exemption. And also, for taxpayers paying tax outside Hong Kong concerning the foreign source income can also enjoy tax credits. To minimize compliance burden and offer support to taxpayers, as well as enhancing tax certainty and tax transparency, we will and have implemented 4 business-friendly measures. First, minimizing compliance burden by simplifying reporting procedures, and also on whether taxpayers fulfill the ESR, there will be an advance ruling by the Commissioner of Inland Revenue. And also, we will upload the examples to the websites of the Inland Revenue Department, and there will also be a dedicated unit with the IRD to respond to inquiries. The stakeholders welcome these measures. They have been set out in paragraph 31 to 35 of the Council brief. The new FSIE regime will maintain our competitiveness in the following areas. First, we only target 4 kinds of foreign-sourced passive income, but not active income. And also, the new regime only covers MNEs. And also, subject to the fulfillment of the ESR and the Nexus approach, the relevant foreign-sourced income will be exempted, regardless of whether subject to tax requirements outside Hong Kong. And also, we have the participation exemption system, allowing tax exemption for foreign-sourced dividends and disposal gains. And also, taxpayers are allowed to claim tax credits under the look-through approach, which is business-friendly. For details, please refer to paragraphs 36 and 37. Concerning the spin-off effects, the government will take a forward-looking approach to make preparations ahead, including studying provision of tax discounts or rather a preferential tax regime for Hong Kong-sourced IP income to encourage more R&D activities in Hong Kong, and look into appropriate measures to enhance tax certainty for transactions and the resulting disposal gains of a non-revenue nature. In terms of consultation, we have briefed the business sectors and the trade on the bill to seek their support. Since the 26th of October, we have conducted several briefing sessions with the Big Four, foreign and local chambers of commerce, tax experts, trade and professional bodies covering accounting, financial, legal sector, and so on. Generally, the industry supports amending the law to address the EU's concerns. They are worried that if Hong Kong is blacklisted, it would affect the material interests of the companies. They also welcome the facilitation measures and the reduced compliance requirement to maintain our competitiveness. We hope that members will support the bill so that it is passed as soon as possible and avoid being blacklisted. So that's the presentation on the contents of the bill. Chair, later on we will introduce CSA, that is a committee stage amendments. Would the chairman like me to introduce them as well? Please do, because it is in relation to the latest development and it has significant impact. Some taxpayers who were originally carved out are now being included as well. So please introduce the CSA. I will invite the Deputy Commissioner, or rather the Deputy Secretary for FSTB to introduce the CSA. Thank you. So these are the key contents of the CSA. It is in relation to Clause 15I in the bill. Under the regime, we sought to provide for carved-out entities. For all taxpayers on the list of carved-out entities, they would be exempted from the FSIE regime. That is, they can enjoy exemption without being subject to the ESR and a nexus approach. So there are two parts on the list. First, taxpayers who are enjoying preferential tax rates in Hong Kong. They would be carved out, as suggested by the industry. Under our Inland Revenue Ordinance, a list of tax concession measures are set out. To enjoy these concessions, they have to fulfill ESR already. That's why stakeholders suggested that we carve them out, because they have already fulfilled the ESR or economic and substance requirements. Otherwise, there would be it would be doubled. So it would be time-consuming and a cost and not cost-effective.
Because of that, we've carved them out from the list of the entities. And second category, as you see on the slide, these are the categories ranging from 1 to 7. So when we consulted the stakeholders, these are the views that we have received. The views received are that the OECD itself already has laid down the regulation regarding tax evasion, and they've already removed some of the entities. There have been views that, given the relevant rules basically are aimed at tackling its anti-tax avoidance, and therefore we will put the same into our bill. I think both views are reasonable, and that's why we've incorporated them into the blue bill, and we've submitted the bill to LegCo. And also, we've also, forwarded our justification to the EU. At the end of late last week, we received a very clear opinion from the EU saying that the way we address the exemption, I think they're taking exception to that, and they would like us to make an amendment. According to the EU, regarding the tax exemption measures, the EU agrees with our rationale. That is, if we have some tax exemption measures and there are already relevant requirements in place, it is therefore not necessary for have double compliance. But the EU believe that we need to be more focused. According to the text of our current ordinance, for the entities which enjoyed our tax, exemptions, they will be carved out from the bill. Since under the Inland Revenue Ordinance, the tax, concessions measures only involve certain incomes of the entities, and for certain of the incomes they have to satisfy these requirements. But they may not cover all the 4 categories of incomes. The EU in particular stress that at the moment our tax concession policies involve non-IP income such as interest, dividends, and disposal income, and it does not involve IP income. If for all these entities which have enjoyed these measures, so if they become carved out taxpayers, one possible consequence is that there might be abuse. And these entities in future, should they receive any IP income, then they will do not have to comply with the nexus rule. So I think this opinion of the EU is not unjustified, and that is why we're removing a CSA. We will, for the corporate taxpayer, we would take it that they will not be carved out entirely from the bill. It's just that some for the relevant incomes which have satisfied the economic substance rule, these will be carved out. Later on, my colleagues will further elaborate on the impact. The second concern of the EU is that for the rest of the list, it's about the Group B rules promulgated by the OECD. The EU's consider that for any tax jurisdiction, if they need to promulgate any FSIE, they should, in principle, they should not stipulate any particular entities and to carve them out of the system. They've also pointed out that although the Group E rules have made reference to these exempted entities, but the applicability may not actually be fit with the current regime, especially if the entity list in the Group B rules, if they would incorporate them in total, it might result in abuses. Finally, the EU also considered that in the whole process, the EU has not just put Hong Kong under their watch list. There are other jurisdictions. They've also looked at the regimes of other jurisdictions and find out whether they are in compliance. They have never, in respect of other jurisdictions, approved any such jurisdictions and regimes to have the exemption regime. If they have such an exemption regimes, it would not be consistent with the practice in other jurisdictions. In other words, there's no consistency. And this means that in the bill, we have to make some amendments to remove that list. And also in respect of this amendment, we've made some assessment. We believe that the taxpayers who will be affected, the impact will be minimal. Thank you. I will now brief members regarding the two proposed CSAs and how it will impact on the industry. First of all, deleting the provision of carving out taxpayers currently benefiting from the preferential tax regime. And so we believe that this CSA does not have any actual impact on the taxpayers, because for all the tax exemption preferential tax regimes, they do not involve IP incomes. So the taxpayer, in respect of their IP income, if they abide by the nexus rule, then the compliance burden will not be increased. So there will be no case of double taxation. As for the carving out of the other affiliated entities, first of all, investment funds. Now I'll explain by way of this diagram regarding the impact. Actually, if you look at this chart, you'll find that for most of the investment funds, they do not have to prepare their consolidated financial statements. In the bill, it is also prescribed whether the company is an entity under the MNE. I think it depends on whether or not they belong to the MNE, and that is whether or not they need to prepare a consolidated financial statement. If they not, then they will not fall into the exemption mechanism. even if the investment fund has to prepare a consolidated financial statement, their interest, dividends, and disposal incomes earned abroad, under the current tax regime, there are provisions which allow for exemption. If it is a publicly issued, fund, according to the existing IRO, Section 26, they will be entitled to exemption. For private equity funds, then based on the exemption for the onshore and offshore funds, they will also enjoy exemption. Even if that fund does not satisfy all these exemption requirements under the IRO, they can still, if they satisfy the ESR requirement or the equity holding requirement, they will be entitled to exemption. We will adopt a practical approach so that in implementing the economic substance requirement, we'll consider the fund managers and their staff and the activities that they are engaged in Hong Kong. Next, for real estate investment trusts, REITs, how would that be affected? For REITs, most of them are actually publicly offered to the public, and according to the current IRO exemption mechanism, they will still continue to enjoy exemption, or if they satisfy the economic substance requirement, because most of the REITs invest in property, real estates. So in terms of employment and manpower and expenses incurred, it's very easy for them to satisfy the ESR requirement. As for insurance entities, since they are wholly owned by the insurance company, and therefore for them to satisfy the ESR is not difficult. And finally, for government entities, international organizations, NGOs, and retirement or pension funds, most of them will not be regarded as conducting any economic activities in Hong Kong, and based on current IRO in Hong Kong, they will continue to enjoy exemption. Overall, so even if all these entities are no longer regarded as carved out entities, I don't think these amendments will have any impact on these entities. So we will now take questions from members. I propose 5 minutes each. Chairman, I speak in support of the proposed legislation. And just now the administration already explained the rationale. Specifically, I note that this is conducive to consolidating our status as an international financial center and also to avoid double taxation. The Bureau also has provided for mechanisms so that taxpayers will not be subject to double taxation, because we have a mechanism in place to obtain the tax credits. So that's the first rationale for the legislation. Secondly, this is not to increase government revenue, but rather to help businesses, entities in Hong Kong, which have transactions with the EU. If they have trade connections or business connections with the EU, they may be. So you've clearly explained that they might be subject to some tax, measures. So when we make a commitment, that when we were put into the watch list by the EU, I think you look at all the requirements of the EU and consider them to be reasonable, and that's why in the Blue Bill you've already reflected the views and requests of the entities which were consulted. For the carve-out entities in the Blue Bill itself, can see that the Bureau has done its level best to fight for the best interests of Hong Kong entities. Of course, after consulting with the EU, we need to move a CSA. So only the relevant incomes are exempted. Now, when we go to the clause by clause, we can further discuss that. The bill which proposed for the carved out entities, they have been put in after consulting the stakeholders, and I think that is compatible with the interests of Hong Kong.
So my questions are, after the amendment, how can we assure that Hong Kong can be maintained on a level playing field with other financial centers, or even at a more advantageous position? How can we ensure that we are not lagging behind other financial centers? Second question on compliance measures. Can you give us more details from the PowerPoint on how the government would help corporates to comply with the requirements? That is page 13, slide 13. Can you tell us more? Which official will take the question? Chair, I would attempt to answer the question, and then I will invite supplements from my team. In terms of maintaining our international competitiveness, the standards adopted by the EU apply not only to Hong Kong, but other jurisdictions as well. For other jurisdictions which have similar taxation regime like Hong Kong, or even more relaxed taxation regime, then they would be put on the watch list of the EU and be required to enhance the FSIE regime. We consider that after the implementation of the new regime, we will not be put at an inferior position than other jurisdictions, because the new regime only covers 4 kinds of passive income, that is interest, dividends, disposal gains in relation to shares or equity interest, and IP income. For some other jurisdictions, their new FSIE regime would cover even more types of income. And also, this amendment only targets MNE group, or an entity within an MNE group. So that may be different from other jurisdictions as well. And also we have put forward a number of exemptions, and also concerning the ESR, or economic substance requirements, we have made reference to other jurisdictions with similar requirements. And our ESR is not stringent, if not more relaxed than other financial centers. So besides the ESR, there is also an alternative pathway to apply for exemptions for shares or equity interest. That is the participation exemption, which is unique to us. And also concerning tax credits, we would adopt the look-through approach. That is, besides the taxation on interest payments, we will also look at interest paid in other jurisdictions under a multiple tier system. So that would help us to maintain our competitiveness. In terms of administrative measures, we will prepare new tax return forms next year. A new item will be included requiring taxpayers to declare foreign sourced income, and there will be other items for the taxpayers to tell us whether they fulfill the exemption criteria. And these are very convenient forms. Simply tick yes or no, and also the number of types of income involved. And also we will implement the advanced ruling regime. If a corporation is unsure about whether they fulfill the exemption requirements, they can apply for an advanced ruling from the commissioner, which will be valid for up to 5 years. In that 5 years, they can declare on the tax return that they have already received an advanced ruling, so that they don't have to submit the information again. So besides, during the transitional period, we have the commissioner's opinion, the purpose of which is similar to the advanced ruling, that is to offer tax certainty for taxpayers and minimize the inconvenience in filling out the tax return. In our consultation with the stakeholders, we have taken on board their suggestions, and we are going to offer real-life examples to show the industries how the regime will be applied. Mr. Rokshan, thank you. I think that the government, especially the FSTB and the Inland Revenue Department, have met with many members prior to this meeting to answer our questions. I applaud this approach. Now, I want to seek clarification on something. There are many entrepreneurs in Hong Kong who has established equity holding company in Hong Kong with foreign overseas offshore companies, for example, in the UK for collecting rents, and another one in the US or Canada for collecting rents as well. They are required to fill out a consolidated financial statement. According to the paper, for M&E groups, they are required to pay tax in Hong Kong. The holding company as well have to pay tax overseas to meet the definition of a M&E group. So is that correct? Second question, we are adopting the definition of M&E under GloBE. For the scenarios I mentioned, obviously these holding companies are not M&E groups. You can, it is evident from their annual turnover and the share value. So besides following the GloBE definition, can you also put in place parameters like NAV, the net asset value, and so on, to make sure that they will have to meet these parameters before they are defined as M&E? Which official will take the question? Commissioner. For our purpose, M&E group means that the group has permanent establishments in different places, and also they are required to fill out consolidated financial statements. Then they would be treated as a M&E group. For entity within the group, they would be the ones that we are targeting. There is no requirement, however, that these entities or companies have to pay tax in other jurisdictions. So for the scenario I mentioned by Mr. Rokshan, even if they haven't paid tax overseas, they would still be defined as M&E entity. In terms of setting a standard in terms of NAV, the net asset value, well, there is a BEPS, a base erosion and profit shifting, anti-base erosion and profit shifting regime. There is a minimum threshold of 750 million euro. Only companies with this level of turnover would be classified as M&E, but we don't have this definition under this bill. The EU is also clear in that we can define an M&E group with the same definition. However, we can't set a minimum threshold or maximum threshold to categorize our target entities. So my first example might be classified as a M&E group, so that they will have to meet the ESR or other requirements to be eligible for exemption. Yes, if they are earning specified income. Let me supplement. According to Mr. Rokshan, the two examples you gave were companies established overseas for collecting rent. To fall within our new regime, a major condition is that they have to have an ongoing business in Hong Kong. So if they fall within the definition of M&E group, even so, if they don't have an established business in Hong Kong, they would not be caught under our new regime. Has your question been answered? Okay. Dr. Johnny Ng. Thank you, Chair. I speak in support of this amendment. I understand this is very important for Hong Kong. Several questions for the administration. Will the government study that after the passage of the regime, the feasibility to offer more tax concessions to attract investments to Hong Kong and make our taxation system more attractive for R&D activities? FSTB. Thank you, Dr. Ng, for your question. When preparing the bill, besides reviewing the competitiveness of the entire regime, we have also studied whether there would be a spin-off effect from the amendments. One such area is IP income. Under the new regime for IP income derived overseas, we have to follow the nexus approach, under which it specifies that the R&D qualifying expenditures has to be incurred by the taxpayer. So it would encourage more taxpayers to conduct R&D activities themselves, or outsource the R&D activities to local parties. At present, there is no concession measures for R&D activities. We only offer a super deduction. For income beyond the super deduction, there is no preferential treatment. So we would ride on this opportunity to study whether there is a need to learn from other jurisdictions. That is concerning IP income. Should we offer specific tax concession measures? This is something that we will actively consider. So actually, there are measures. We can see that our IP taxation regime is weaker than Singapore, so we are going to do something. Mr. Edmund Wong. Thank you, Chair. On the 4th of July, as the FA panel, we were briefed by the administration on the bill. In the past 3 months, the administration has met with me and my sector for no fewer than 10 times. They have addressed our major concerns and introduced some amendments. This exercise is for responding to the EU's requirements, and the timetable is very tight. So we will try our best to scrutinize the bill as soon as possible. So on the ESR for pure equity holding company, does the company need to have a permanent director in Hong Kong? On the IRD's website for outsourced services, including a nominee directors and services or keeping of records. If there is no monitoring of such activities, the taxpayer may not be able to fulfill the requirements. It is a bit different from our understanding during the consultation. Concerning BVI or Cayman Island companies, under the EU's requirements, these jurisdictions allow nominee directors as services. They can still meet the requirements of EU. Now, retain
and assessing economic substance for purely equity holding entities. 如果佢哋 BVI 同埋 Cayman Island 佢哋可以符合到嘅時候，咁點解我哋要？
So when the BVI and the Cayman Islands companies can fulfill these requirements, why do we have such a stringent requirement?
Thank you, Mr. Wong, for the question. I believe Mr. Wong was referring to the example which we put onto our website. That is for, a nominee director in Hong Kong. Would that company satisfy the economic substance requirement? What I'd like to say is that example shows clearly that the company, other than having a nominee director, the stipulated economic activities for the company takes place overseas. And that is why the reason why this company does not satisfy the economic substance rule. That is, whether or not the company has a, director or nominee director in Hong Kong, that is not the decisive factor. To clarify this point, the ILD on our website already added a new example 14, which shows that even if the company has only one nominee director, if their designated economic activities are outsourced to a service provider in Hong Kong, and such activities actually takes place in Hong Kong, of course that company would need to actually supervise or monitor the outsourced activities to ensure that it's done in Hong Kong, in which case they can satisfy the economic substance requirement. Mr. Chen Xiu-hong, thank you. Chairman, overall I support the bill because the bill can prevent Hong Kong from being put onto a watch list by the EU, and that will be subject to penalties. And also we can also prevent MNEs to set up shell companies in Hong Kong and thus jeopardizing our reputation as an IFC. Now, even though the bill has introduced the new FSIE and stipulate certain foreign source incomes, which are not Hong Kong income, in page 45 of the PowerPoint, it is said that the bill can, enhance our competitiveness, but there might be implications. My question is whether or not we have followed other jurisdictions like Singapore and compare ourselves with the exemption mechanism, and if so, what are the competitive edge that we have to enhance our taxation competitiveness, and in what other areas are other jurisdictions more attractive? Secondly, page 14 of the PowerPoint, the government has provided for the participation exemption so that tax exemption would be allowed. This is new. The participation exemption is not common in other jurisdictions. I'd like to know which other jurisdictions are implementing this exemption. And thirdly, in the legislative brief, para 17D, that is to satisfy the economic substance requirement under the FSIE, the taxpayer has to go through a test. For example, the adequacy test, he has to employ sufficient number of employees and incur a sufficient amount of expenses. What is meant by adequate? So I think we need to be more objective. Will the ILD provide some objective guidelines? Commissioner? Thank you, Chairman. To answer the member's question, first of all, regarding how we compare with Singapore, actually, I think the Commissioner already said that in Singapore, in respect of foreign source income, the taxation regime has a wider coverage. Any foreign source income, so long as they are received in Singapore, then they're already subject to taxation. Whereas under our system, we only cover 4 types of incomes. So I think our scope is much narrower. And secondly, regarding taxpayers, this time we are only covering the multinational entities. Whereas in Singapore, they would cover anyone. So long as they receive such incomes in Singapore, they will be subject to taxation. Thirdly, regarding the tax exemption arrangement, in Hong Kong for these 4 types of incomes, so long as you satisfy the economic substance requirement or the participation exemption requirements, or you satisfy the nexus approach. If we're talking about the IP income, you will continue to enjoy the exemption. In Singapore, they do have an exemption mechanism, but it only covers 3 areas, 3 incomes. That is dividends, income of foreign subsidiaries, and service income. And the exemption mechanism there only apply to companies which belong to their own residents, and these companies would need to be managed and controlled in Singapore. So there is still this economic substance requirement. More importantly, in respect of dividends, for the exemption, other than the economic substance requirement, there is a requirement for the company to, in respect of the dividends and profits, it is required that they have to pay at least 15% tax abroad. In Hong Kong, the exemption for dividend in Hong Kong is that if you satisfy the economic substance requirement, you're already entitled. So for the interest earned abroad, if you satisfy the economic substance requirement, you are also exempted, whereas that is not the case in Singapore. Finally, in Hong Kong, we have extra measures in place which Singapore does not have. First of all, the exemption mechanism, and also the look-through approach. Again, Singapore does not adopt the same approach. They only look at 2 tiers. So overall, I think we are better than Singapore in several areas. For the participation exemption, in some jurisdictions, this is already in place. For example, in Europe, it's quite common, such as the UK, Luxembourg, and the Netherlands. All these exemptions are already in place. When we designed the participation exemption mechanism, we've already taken into consideration or reference of the systems that are in place in those jurisdictions. Finally, regarding the adequacy ratio, the requirement of the EU is that the economic activities must satisfy 2 requirements. First of all, the number of employees and the operational expenditures. The EU has indicated that we cannot draw a line to define what is adequate, because different companies may vary in size. The amount of profits may also vary. The activities that they engage in may be different. So the EU's opinion is that we cannot adopt a broad brush approach and to define what is adequate. In considering this mechanism, we have considered that since the present mechanism will apply to different taxpayers in different industries, if we draw a rigid line, we're afraid that some companies which are very small in scale and they would still not be exempted. And that's why we have to really look at the scale of the company concerned, the profits that they've generated, the nature of the business to determine whether or not they satisfy the adequacy ratio. I think this approach in our facilitating measures, we've adopted the same concept. That is, we have this adequacy test. We understand that taxpayers may not be very clear whether they satisfy the adequacy tests. And that's why we have measures in place. For example, we have the advance ruling and the commissioner's opinion. We encourage taxpayers to apply to us for such an advance ruling or the commissioner's opinion so that they can know well in advance whether or not they satisfy the requirement. And that we can give them, if we can give them a positive opinion, which is valid for 5 years, then during those 5 years, they have the certainty that they have already satisfied those requirements. So these are the ways by which we can help the taxpayer to satisfy our requirements. Mr. Chen Chin-ying. Thank you. I also support the bill like my colleagues. I also like to thank the Bureau for having communicated with us so many times. I have, several questions. First of all, the EU is asking us to amend our inner revenue ordinance. According to estimate, for how long before the EU will trouble us again, and that we don't have to move further amendments further? And secondly, I'd like to ask the same question as Mr. Chen Xiu-hong, that is comparing ourselves with Singapore. Having heard your answer, I must point out that during the last EU, audit, Singapore passed the test and we did not. Now, after the present amendment, we are better than Singapore in all respects. But in that case, we may still continue to be non-compliant. What is the reason? Or how can we convince the EU to be satisfied that we are in compliance? 3 micro questions. I think the Commissioner has talked about the mechanism of advance ruling, which is valid for 5 years. After you've given that advance ruling, if the nature of the business of the company changes, will the company have to proactively apply to you again for that ruling, or do you take random tests to satisfy that there are major changes and you have to, rescind the advance ruling? Or do you need proof of actually, for example, tax credit? Now, the IRD may have some examples in the past when the company concerned submit evidence that they have paid tax overseas. Do you have ways to prove that? I don't know whether such evidence, there is a consistent requirement as to the nature of such evidence. Thirdly, implementation is the most important. How can we ensure that the bill will enable businesses in Hong Kong, SMEs and MNEs, will not, because of the new, regulation? I think the important thing is the IRD. We have to set up task force. You have to handle the new applications. You have to conduct tests about the adequacy requirement and so on. So when this bill comes into effect, how much extra manpower do you need to satisfy the requirements of the new regulations? Thank you, Mr. Chen. First of all, to answer your first question as to for how long the EU will check on the jurisdictions conditions. My understanding is that since 2017 we already have the EU listing mechanism. Every year they will update the list twice a year. They will check the tax regime in other jurisdictions to see whether there are anomalies which do not satisfy the standards. Since 2017, Hong Kong has been subject to review. In the past, the review was focused mainly on our tax exemption measures. In the past, because of the EU's requirement, we had amended the exemption mechanism for funds. We did that in 2018. But actually, in the whole process, on and on, the EU has been updating their own standards, the amended standards. Take the FSIE mechanism this time. At the end of 2019, they launched this new guideline, and immediately after that, they started to audit or check other tax jurisdictions to see whether their mechanism comply with the new requirement. So So this is a continuous process. I think right now, whether it's in the EU or internationally, the taxation standard are changing all the time. The OECD is actually working on a minimum tax threshold. So we cannot rule the possibility that this will continue to take place going forward. But our attitude will remain the same. If the EU requires to make some certain amendments to satisfy the requirements, the first thing we do is to ensure that that standard has already been promulgated in the EU.
嗰個標準呢，
Second, the standard must be a consistent one that is complied with by all the tax jurisdictions and not just Hong Kong. If these two requirements are met, then we would consider whether we would revise our taxation regime to meet with the EU's standard. Of course, before any amendments, we would consult the industries to gauge the impacts on us. Second point on Singapore. Why is it that for the FSIE regime, the EU gave Singapore a pass this time? Actually, there is a fundamental difference in terms of a taxation regime between Singapore and us. They do not fully comply with the territorial source principle. For taxpayers with foreign sourced income, which is received in Singapore, it is subject to tax. So there is a fundamental difference. Foreign sourced income is not subject to automatic tax exemption in Singapore. That's very different with us. Second, the Singaporeans' exemption regime only applies to companies set up by Singapore residents. That is, there is already an economic substance requirement in place. As far as the EU is concerned, the SR is met. That's why the EU considers Singapore not taxation harmful. So our proposal has been negotiated upon with the EU in terms of the coverage of income and also the types of taxpayers covered. There has been numerous rounds of negotiation before we come up with this proposal. So maybe the scope is narrower than that of Singapore's, but still, EU thinks that there is a need for us to change the regime. We are confident that after the change, we will be able to meet the EU's requirements. Concerning the implementation details of the new FSIE regime, for example, advance ruling. What if there are any changes during the 5 years validity period? At present, the IRD concerning the provisions, the other provisions under the Inland Revenue Ordinance, taxpayers can apply for advance ruling on these components as well. So usually, the ruling would be valid for a certain period of time. During that period of time, if there are any material changes, the taxpayer is required to notify the IRD of such changes. On the other hand, we will also review rulings given. If we identify any material changes in circumstances, we will not make the ruling void immediately. We would ask the taxpayers the background and reasoning for such changes before we decide whether the ruling is still valid. We won't simply revoke the ruling whenever there is change. In terms of tax credits, on the information required, we do have a tax credit regime in place. For example, for taxpayers who have paid tax overseas, there would be tax statements or tax receipts. These are documental. These are evidence that we would accept for tax credits claim. For different jurisdictions, the documents required as proof would be different, because for some jurisdictions, self-assessment is allowed. So it really depends on the jurisdiction. We won't make it a hard and fast rule that we must have the tax receipt to approve a tax credit application. So at present, we will only offer tax credits to jurisdictions which we have entered treaty with. So we can confirm with the relevant authority whether the receipts were issued by them. So we believe that there would not be major difficulties in terms of confirming the validity of the documents. In terms of manpower, there will be a dedicated team to follow up on this new regime, simply for offering technical assistance to taxpayers. So that dedicated team, besides the new FSI regime, as we know, there will be the global minimum tax rates. In the future, there will be more compliance work for M&Es to do. So the dedicated team will also serve these M&Es in the future. At present, there are some 20 staff in the team. So when the global minimum tax rate is implemented, the dedicated team will also serve M&Es in this regard. So thank you, Ms. Eunice Yung, for waiting for a dozen minutes and for allowing the Deputy Commissioner to answer the question in length. Ms. Eunice Yung, thank you for your patience. Now is your turn. Thank you, Chair. As long as the question is well put, we would like to hear the answer. So I'm totally fine with that. I thank the FSTB and the IRD for giving us a lot of background information in advance so that we can ask detailed questions and speed up the scrutiny work. So my question revolves around the ESR and the principle and the definition of economic substance. According to the paper, there are some definitions. For example, labor-intensive industries and nature of business, number of part-time and full-time employees, and also whether the experience of the employees are related to the nature of business and whether the office is used for carrying out the related activities. Now, under the epidemic, many corporations do not have an office. They may be recruiting employees online, and employees may be allowed to work at home. So how would you define office, and how can corporations meet the requirements? And what about the EU? For corporations with most employees working from home, how can you determine whether the working hours and inputs by employees meet the requirement? Thank you, Ms. Yung, for your questions. Now, briefly, the requirements on office is one of the considerations that we would consider for companies that are not a pure equity holding company. The ESR would mean sufficient adequate number of employees and a sufficient operational costs incurred. So the two most important things are the number of employees and the operational expenditure. The EU has reiterated on many occasions the importance of these two requirements. So these are the ones that we will be focusing on. In determining the adequacy, we would consider the office of the taxpayers in Hong Kong as well. But we would not disregard the operational reality of the taxpayer completely. For some corporations, they may not be of a major scale, and sometimes office is not required, but we would mostly be considering number of employees and operational cost. Mr. Edmund Wong. Ms. Yong's questions were very reasonable because there are a diversified range of operation models. And also, you haven't draw a line on the ESR because the EU has said so. So what if the EU comes back and challenge our commissioner's opinion and advance ruling? If we draw the line to lax and then upon EU's challenges, we have to tighten it, then what will happen? Now, according to 15C1 for M&E groups, which has disposed of equity overseas and incurred a loss, then for that tax year or the next tax year, that can be a deduction. But that's only applicable to a specified foreign source income. But will there be a carrying backward arrangement for it? Currently, there is no such arrangement. For loss incurred by disposal overseas, it may be a very sizable amount, and it may be carried back for many years, and it is not convenient for the business. In terms of tax credit, it seems that it is not fully consistent with other provisions. For example, qualified IP, if there is a loss, there would not be a restriction. So why is there a more stringent requirements for this? For 15L pure definition for a pure equity holding company, that is a company as its primary function only hold equities interest in relation to the incomes incidental to the acquisition. So an example is bank interest. Are there any other examples? So if there is a shareholder loans for other subsidiaries, for that income, would that be deemed as incomes incidental to the acquisition? Thank you. So, Deputy Commissioner. Thank you, Mr. Wong, for your questions. On Commissioner's opinion, we propose that when an opinion is offered, it would be valid for 5 years. If the operation of the taxpayer meets the commissioner opinion's requirements, then it would be deemed as having met the requirements. As long as the ESR is fulfilled, then we would handle the case according to the commissioner's opinion. In terms of the adequacy of our ESR as deemed by the EU, according to our discussion, when considering the adequacy of ESR, we have to take into account the full facts. As long as the opinion is based on the full facts and the individual circumstances of the taxpayer, that would not be a problem. On loss incurred by disposal and the tax credit limits for it, under the existing provisions, disposal gains from capital is not taxable. Similarly, loss incurred by disposal of capital will not be deductible. So after the change, we are aware that disposal gains incurred overseas may be taxable under the new regime. So to achieve comparability, we have taken on board suggestions by the industry that loss incurred by disposal overseas can be deductible. Well, if the transaction takes place overseas, it may pose difficulty for us to confirm it. So for loss incurred by disposal of equity overseas, there is a risk of tax avoidance or abuse. So while balancing the risk, we recommend that we would limit loss deductible to taxable income overseas or offshore income. We hope that we want to achieve comparability between the gain and loss incurred overseas. If that requirement is met, that is acceptable and the risk can be addressed.
Regarding the definition of participation, exemption whether or not the holding company can hold other assets. I think in the bill for purely equity holding entity, there is a definition. Such a company can only hold the equity and can only earn dividends and disposal income and other related income. And that definition, according to the guidelines, was made according to the EU guideline. Based on that definition, if a company, other than holding the equity, there could be shareholders' loans which have been loaned to its subsidiaries. Then they can satisfy the participation exemption requirement. We have taken into consideration low tax regime, jurisdictions with low tax regimes or zero tax. I think many of these jurisdictions are already implementing the economic substance rule. In doing so, they would adopt the same approach. If there is a shareholder's loan, it can no longer be a pure equity holding company. We understand many taxpayers are concerned about this point. That's why on our website we've already added this point to clarify the issue. Regarding the carrying backward of losses, our colleagues can supplement. I think our system at the moment already allow losses to be carried forward. If losses were to be carried backward, we allow it to be carried forward. So I think we need to be consistent here. If we allow that, it's possible that we may lose some of our tax revenue. Like the Commissioner said, losses incurred abroad, it's difficult to substantiate that with evidence. If we allow it to be carried backward, there is a greater risk of abuse. Now, if the shareholder loan is interest-free, will it affect the status of the equity holding company status? No. The definition says it cannot hold any non-equity related assets. So whether it's interest-free or not, it will not satisfy the definition. You may continue, Mr. Wong. Another question is about 15O, that is foreign source income is regarded as disposable income. If the tax rate is more than 15%, then it will be covered. I think this is not consistent with the consultation paper. And say, for example, in Hong Kong, we have mainland subsidiaries. If certain conditions are satisfied, in the mainland, the tax rate is 10% and not 25%, which is common for enterprises in the mainland. In that case, does it mean that they will not satisfy the definition of 15.0? Thank you. To answer Mr. Wong's question, for the subject to tax condition, I think in negotiating with the EU about this arrangement, the EU attach a lot of importance to this condition for subject to taxation as a means to avoid abuse. They've also pointed out that in determining whether or not, subject to tax requirement, other than the headline tax rate, we have to consider other factors. For example, whether the taxpayer enjoys certain tax exemptions or a preferential tax rate. All these factors to be considered. In other jurisdictions, they're also adopted. For example, in Singapore, they would consider that if the taxpayer enjoyed a preferential tax rate, they will not use the headline rate, they will use the preferred rate, preferential rate. So it's consistent with similar jurisdictions. If the dividend whether or not the dividend should be subject to tax before it satisfies the requirement, we will look at the case in question. And on our website, in the FAQ that we provided, we already have an example showing under what circumstances we will consider doing that. For the 15% tax requirement, if there is an accounting and taxation difference, so there could be a surplus and there's no need for tax paid. I mean, would that be, in compliance? Well, we have considered that some taxpayers, like Mr. Wong said, when they pay out dividend in a particular year, for some reasons the company might have incurred a loss, and as a result they don't have to pay a tax, but they are still able to pay a dividend. In the FAQs we provided, we've shown that if the taxpayer can submit evidence to prove that the profits used to pay out dividend actually were accrued in the previous year. They may not have to pay any tax this year, but very often the profits paid out as dividend could have been tax ready in the previous year. If there's evidence to prove that, then we will take that in consideration. But the taxpayer has to prove that the dividend paid out had already been subject to tax beforehand. The taxpayer has to be able to trace such profits to provide the evidence. In other jurisdictions, like Singapore, they also adopt the same approach. Any other questions? If not, I think this is our procedure. We need to deliberate on the policy matters first and then next proceed to the clause by clause. We have some members who have not yet arrived. May I propose that we take a break of 10 minutes, and 10 minutes later, if there are no further questions from members, then we will proceed to our clause by clause. All right, let's take a break for 10 minutes and come back at 4:35.